got a special guest here with me now. Colin Fisher is the CEO of StableView Asset Management. Colin, welcome back.
Thanks for having me back.
Now, Colin, StableView Asset Management is principally interested in the Canadian technology landscape, and so that's a refreshing break from our focus on cannabis. So tell me, how is the technological landscape from an investor's perspective going into Q1 2019 in Canada?
Well, it like anything else, got a bit of a spanking in the last quarter of last year. Yeah. A lot of what I'm seeing is starting to recover quite significantly. I think, you get the cascading effect of stock price goes down, you run into tax loss selling, and then that really starts to punish it into the tail end, and you have the pile-on of the fact that a lot of liquidity typically dries up in the tail end of last year. So. Or of any year when you're getting into tax loss selling area. So a couple of the stocks that I've been looking at are starting to rebound nicely. Mm-hmm. A lot of the time you get in technology. If the companies are performing well, you can splice this out in a whole bunch of different ways. But at the end of the day, if you have real companies doing real things and making real money, and the market writ large writes off, unless they're in nosebleed valuations, they will typically recover relatively quickly. So
is that what happened in Q1 so far? What are we,
8-9 days in?
Well, the cannabis space, everything that had sold off by 50% is now a lot of it's back up 10, 15, 20, 30%.
So a number of the positions that I've been in, a couple of them are up in the 20s, 15, 20s.
Oh, okay.
But it's all relative, right? It depends on where you're at. You're getting, some of the hangover effect of, the Apples of the world starting to show, that they're having growth problems in China. They're starting to show that some big macro events are going against them.
I saw LG reported 80% drop in revenue.
Yeah, so
that's pretty huge.
Yeah, so a lot of these consumer elements, right? So, in the big tech has parallels to credit. So if the consumer's starting to get tapped out, some of these more consumer electronics, they don't have recurring revenues built in, right? So they don't, that like an LG is typically more of a B2C type product or type of company. A lot more consumer facing. Same thing with Apple, a lot more consumer facing. So the more consumer facing, the more sensitive to the overall macro environment, including things like credit. Our consumers tapped out. If you're getting into that type of thing, then the bigger companies are typically more sensitive to that. So you're going to have the Apples, the LGs, and whatnot. Whereas if you have companies that are typically prevalent in the Canadian landscape, which are B2B companies. Like 99% of all of our tech is B2B.
Right.
We're not a big consumer, we're just not big. We're like 35 million Canadians across the country. So as a consumer marketplace, we're microscopic. So the vast majority of the technology that is addressed in Canada is servicing businesses, and so the B2B typically has less volatility in the in their revenues, particularly if they are contractually based or they're a recurring nature in their contracts. Mm-hmm. So that's a lot of what I invest in is primarily. Okay. It doesn't mean you don't get a spanking if the market's getting spanked with everything else. It's just that typically the recovery is a little bit quicker as there's a little bit more meat on the bones for post any sort of
So if technology is leading the sell-off in the broader market, which is the case, arguably.
At the larger cap, yeah.
And that has the effect of taking all segments lower. Mm-hmm. How do you position yourself for a year like 2019 where there's this huge risk of recession, given all the macro political, you've already got technology leading the broader market to the downside, the interest rate question is still not exactly a given. Yep. So what do you become more attracted to? What do you become less attracted to in such an environment?
Well, thematic, I don't know if I'm thematic necessarily per se, but if I was to say what is it that I'm looking for commonality in the type of companies that I'm investing in, typically what I'm looking for are the types of businesses wherein you have a service that is not going to be cut off. Like, you are tied to that. You need that. I mean, I used as an example, and I found an exception to the rule, but let's say you were renting a pacemaker. Let's say pacemakers were heart as a service.
Okay.
Right?
Lifespan as a service.
Lifespan as a service. And you had to pay a monthly rental on that.
Okay.
My suspicion is that everyone with a pacemaker is paying their pacemaker bill. They need that pacemaker if you want to kick around.
Because they can cut it off if you don't pay?
Well, I mean, if you want to go into some dystopian universe, yes. But the idea is that if you need a pacemaker to stay alive and you actually want to stay alive, then you would pay that bill because it's so critical to you.
Right.
The funny thing is I use that as an example, and then literally the next day I had a conversation with a friend of mine, and her aunt, great aunt, decided not to go and get the battery changed in her pacemaker, and she passed away a few weeks later.
You're kidding.
But she was like, I'm done. I can't, because they keep kicking you back. Like, if you're about to start fading, then the pacemaker kicks in and you're back to life, even if you don't want to be. So they were saying, oh, you got to replace your battery. She's like, no, I don't. And that was it. So,
and then replacing your batteries is not just like open a slot and stick it in.
No, 100%. No.
It's like under the gun and under the knife.
Yeah. So,
wow.
So what I was saying is
sorry to hear that.
Well, no, but it's a proof positive that even really good business models like a pacemaker rental service on a monthly basis isn't going to have a 100% recurring revenue from your client base.
That's true. That's true, I guess. Okay, so I'm seeing a lot of foofara around artificial intelligence.
Oh yeah.
And I'm curious as to what's your sort of exposure, take on the sector as it's emerging.
So AI is, I think one of the, so, you know, you get these stories that engage the animal spirits of the investor. This is so exciting. What are the capabilities? It was like the internet's in, in the early 90s, early 2000s, you know, everyone was, you know, what could it do? Mm-hmm. You know, if you go back to the 2000s, you know, you have to remember that there were companies that were, it was a travel agency with a website, and the idea was, oh, you could access the world. Anyone can order off. Of course you could, but the technology, the infrastructure, all of the things that surrounded the ability to make a sale wasn't there. So that company had $300,000 in revenues and was worth $1 billion. So what it does, like we had the blockchain. Blockchain was, you know, all of these capabilities, and then the crypto surrounding the blockchain and all of these elements. The excitement levels there. AI, in my opinion, is one of the more realistic and current, like contemporary solvers of problems. It's a real business right now that can solve real business problems. I think it was Scotiabank that bought a chatbot, and they bought the chatbot for the purposes of collecting, so they could put that chatbot, and if you owed them money and you were delinquent, well, now you have, you know,
pop-up box to annoy you.
Well, no, I was thinking more like a Terminator, right? Like, I mean, it doesn't sleep, it will never tire, it's coming after you at all times, it is coming to collect your dough. Huh. And when you look at, you know, so when you look at like whenever you look at an application of technology, you're trying to figure out where is the fat part of the problem that has the highest cost and the greatest amount of benefit if you solve that problem. So a lot of fintech companies, many times, you know, I think I mentioned this the last time, is if, you know, if I'm making your shirt and the material of your shirt is $200 and the buttons are 5 cents and I'm solving a problem on your button, like, oh, I can make them half the price, right. It doesn't materially change anything. In the instance of when you look at the problem of, for example, lending, and you know, you have a lot of lending tech companies, and when you get into that, you're going, okay, well, the big problem is in the collection. The big problem is employing people to collect and do the administration around that. And so what I think is, you look at AI for that application is massively important, massively important. So I think AI is going to be one of the category killers. The problem is how do you invest in it, right? And this is part of the issue, is that you get all this excitement. So you hear all of these big money going into these areas. And I liken it to, I'm going to use a slightly less evil sounding example, but you know, if you have, I'm trying to think of one that, okay, I'll just use the one. The concept of disruption and chaos. If you take a whole bunch of pit bulls and you put them into a pit and you say which one's coming out, it's a random. You have no idea. They're all big. But if you have a pit bull in a big pit full of chihuahuas, there's a high probability. So the first one's chaotic. The first environment's chaotic. The second one is disruptive. So in the AI world,
for the chihuahuas.
Yeah, because if you assume, yeah, for the Troy, if you assume that the entire industry,
Who's that guy? Oh no,
that's going to, and from a technology point of view, that can happen from time to time. So AI took a long time, but the computing power and the GPUs and all that ability for that processing power now is real and live, and they can do amazing things. So I think AI is massively useful. The issue is going to be, I think there's going to be more hype around the application, and a lot of the winners are going to be, we'll never see them. It'll be companies that have, like Scotiabank, for example, it's going to drive down their costs. Same thing with blockchain. The big thing about blockchain is driving down costs initially. So to find a company in that space is going to be difficult because most of them are germinated in the private market, and for you to get your mitts on them, or somebody else is going to buy them out well before they become public. So, you know, I would imagine the vast majority of your viewers are playing in the public markets. There's going to be AI type things coming out, but a lot of them aren't going to be, in my estimation, really investable. A lot of them are going to be more hype than they are going to be, far more sizzle than there is steak.
Okay, well that's interesting, Colin. We're going to leave it there for now and come back to you again next week.